a quick analysis of theory versus reality, because the secondaries as a sub-asset class has a number of textbook advantages. So they might be, transparency. You're not investing in a blind pool and putting your money to work quickly, buying at a discount. To what extent are these advertised advantages applicable to today's market?
Yeah, sure. And I think that's a great point, Ross. So all the things you mentioned, the traditional advantages. So what are you getting over and above a normal blind pool private equity fund? Generally speaking, you're buying assets which are mature. So you're getting, 60, 70% visibility. You're buying into funds, you're buying into GP-led. So you're buying assets, you're reducing blind pool risk, and you can diligence your manager up front. What else can you do? You're potentially getting near-term cash flows. You're coming in fundamentally at a different point to the original investors. So you should be nearer to your end cash intake. So, from that point of view, I think the market today is still, advertising what it used to offer. Now, buying at a discount, in this current market is a difficult one. I think you only have to read the general sort of industry reports to know that discounts, have been minimal. If not, people are paying premiums for blue chip names. So you're only getting discounts if there is a reason for the discount, which could be to do with the vintage of the underlying asset, could be something to do with the GP, it could be something to do with the underlying actual assets themselves. So, there are episodic reasons and each fund gets priced separately. So, but what's different now compared to, say, 2005, when, I first started doing secondaries? Number one, the market's completely different. Those days, I think annual deal flow, probably single-digit billions. Last year, we're talking somewhere north of 70 billion by all accounts from the various advisors that we see. So what's changed? There are far more choices in terms of strategies. So people, are doing different things, like, for example, doing LP interest trades only or GP led transactions only. Some people concentrate on P, some people do the sub-strategies like VC, infra, real assets. So I think there's a real difference in strategy in terms of the underlying buying community and the secondary funds in particular. And also there's a huge variation now in terms of size of the funds. So you have big guys who are, trying to raise double-digit billion funds, and you get the smaller end of the market who are raising, sort of 100 million, or sub 500 million funds, and they play in a fundamentally different place. So I think as the market's matured, the range of strategies, the size of the funds, and how they go about investing has changed enormously.
So there's been an explosion of different kind of niche funds in the secondaries market. What's brought it about? I mean, that's a very short space of time, 15 years from, you said,
Sure,
single-digit billions to 70 billion a year.
When secondaries first started, sort of, I think, late 90s, that was really a market for distressed VC sellers. And it was a little bit of a dirty market, quite frankly, where it was only for distressed sellers. People didn't want to know that, I'm selling a piece because I'm in trouble. That's what really the connotation was. And I think really sort of the mid-2000s, sort of in the run-up to the GFC, was really the time period where the market started to mature. People started thinking, this could be a liquidity solution for my private equity portfolio, which was beginning to grow in number, both by GP, the number of funds. My team hasn't grown. The admin burden is enormous. For example, Cowper's, I think, the first 1 billion sale, and that was a little bit of a landmark because people started realizing, it's not a distressed market. I can use this to actually get liquidity for my portfolio. So I think that's a big mindset change. And so LPs started using it to manage their portfolio. GPs realized it's actually not a bad thing for your LPs to turn over, because in a closed-ended fund, this is the only way that you can get liquidity to liquidate your LP position. Now, I think recently the real development has been the GP-led secondary space, where in terms of providing a solution for LPs, now it's turned into let's provide a solution for the GPs. Pre-financial crisis, there was a period of time where we had what was called secondary directs. So this was a lot of the times like VC incubators from corporates being spun out with GPs being parachuted in. You had some tail-end VC funds which needed a liquidity solution. And I think those are kind of the forerunners to the GP-led transactions today, where it's gone one step further, which is, GPs proactively taking action to really deal with things like what happens when my fund comes to an end. Let's proactively provide a solution to LPs. And this is now morphed into, single asset GP secondaries, where GPs are saying, well, you know what, I have some really good portfolio companies. I don't think it's the right time to sell because we can do more with it. So, if we can find a market price, that's market tested, we can roll over and find a new group of LPs, who are willing to stay with the ride for longer. So I think in the ever morphing, ever flexible and solution finding secondaries land, this is kind of the latest, sort of major step. And just to give you a sense, I think, roughly 1/3 of last year's deal flow volume was in GP-led secondaries, which is an explosion when you compare it to the size it was 5 years ago.